The Middle East situation is changing constantly. On Sunday, the US officially joined the fight, launching unprecedented airstrikes on Iran. This situation escalated further. Right now, the market is waiting for Iran's response and actions. In fact, looking back at US stocks over the past 2 weeks, it's clear that during this period, the market hasn't been as weak as many feared. Since Israel's first strike on Iran, the market's reaction has been relatively calm. Why do I say this? Because the S&P 500 shows it. Over the past 2 weeks, the S&P 500 is down only about 3% from its February record high. Why is that? Because investors expect the conflict to stay local. They don't think it will have a broad, lasting global impact. But if Iran reacts to the latest developments, for example, by blocking the vital Strait of Hormuz or attacking US forces in the region, then market volatility would likely rise. We can be sure that in the short term, the market will worry about Iranian retaliation or a potential Hormuz blockage. So far, no facilities containing nuclear material have been bombed, and the Strait of Hormuz remains open. But risk aversion is definitely in the air. That said, this sentiment may not last long. US stock futures fell overnight, but not sharply. The drop wasn't big. But what we can't ignore is that all three major US indexes are showing signs of weakness. Looking at the S&P 500, for the S&P 500, MACD had already flattened out and then formed a clear bearish crossover. That downside momentum is now gradually picking up. You can see that it's starting to accelerate, and the index itself is obviously moving lower. Then on Friday, something stood out, and that's volume. Prices fell on higher volume, especially at the top after this prior rally. The index is now turning down. That's a clear sign, especially with volume picking up. That surge in volume on Friday makes the market look much weaker. You can also see this on the intraday chart. On Friday, even though it opened higher, overall it trended lower all day. The index stayed below the intraday moving average, and the price action kept running into moving average resistance, and as it went, the volume clearly picked up. That's why short term, all three major indexes are now showing clear signs of a potential pullback. And it's not just the S&P 500. Let's look at the Nasdaq as well. For the Nasdaq, you can also see a bearish crossover, and short momentum is gradually building. That means the downside signals are getting clearer. And at the top, you can see obvious resistance. That overhead level is keeping it capped. And without any strong volume breakout to resolve this deadlock, the market stays stuck, and we will probably see this choppy action continue. If it drags on too long without any upward breakout, the long consolidation can eventually lead to a drop. So short term, the market looks weak, and the odds of a downside adjustment are high. That chance is fairly strong. Look at the Dow Jones. Right now, it's already below its moving averages. That's under all key averages, and there's a bearish crossover. MACD also just crossed down, and the volume picked up too. On Friday, it printed a small bearish candle, so overall, the market looks weak. That bearish signal is now in place. Now, let's look at some individual stocks. First up is the highly watched big tech giants. Among those seven names, I noticed that Google dropped quite a bit on Friday. Its decline was larger. Google was down nearly 4%. And if we look deeper and do a quick analysis on Google, you will see that it's been on a fairly steady rise of its prior lows. That's been its pattern. And fundamentally, with its AI progress, the market has a positive outlook. Investors are optimistic about its long term prospects. but price wise, it's not very strong, and the momentum is more cautious. Every time it advances a bit, it takes a small step back. Although it hasn't risen sharply, it's been pretty stable off its lows. The uptrend looks solid. And now, at this point, it's pulled back near its trend line, and it's broken below its moving averages. The 5, 10, and 20 day, that's three moving averages lost. So short term, the stock looks a bit weaker, even though the long term uptrend may still hold at this level. That is, the price has pulled back from the prior trend line, so overall it could eventually bounce up. But short term, the picture looks weaker. And with this sell off, the volume picked up too. You can clearly see that Google on Friday saw heavy selling and the drop was steep, almost 4% down. That's not a small move. And intraday, you could feel the panic. That kind of drop was steep, driven by panic selling, that's clear. And with this panic like sell off, the downside was steep. That's a sharp move. And then it continued to slide lower. That kind of action clearly looks like panic. So, in the short term, to absorb that, it will take time. That means price will stay relatively weak, at least for a while, right around this level. Even if it's seeing some support, you still have to consider what's most likely going to happen next. More likely, after this bounce, you will see it chop sideways in this range for a while. So short term, expecting a big move up or down is unlikely. More probably, it stays weak and choppy. Even if it finds some support here, the odds favor a weaker sideways move. And especially recently, over the past several days, you can see this sharp drop on the candlestick chart. That kind of range, that kind of strength has been the most severe recently. That's why it still looks weak short term. A choppy bearish bias is the most probable, and there was heavy volume on this steep drop too. And if we look at the longer time frame, the weekly chart, we can see it's also not very positive. Even though it's been rising, this signal here is concerning. That trio of weekly candles could form a top, and this area looks like it might cap further gains. That's because there's a top pattern. We can't be 100% sure yet that the top is confirmed, but the signals are there. The rally looks stalled, and those three weekly candles have formed a top pattern, which signals overhead resistance. And this level clearly has a look of a bearish engulfing setup, and those two candles shows the prior uptrend. But they also left long upper wicks as prices failed to hold their highs. That long week is clearly capping the move. In the second week, you can clearly see a full-bodied bearish candle. And on the next one, there's hardly any upper week. That's very obvious. And what kind of pattern is this? It's what we call a dark cloud cover. And this pattern is also a bearish reversal. That's why here the intermediate term trend could weaken in the short term. And the odds of a further rise have gotten smaller. Although MACD is still on a weekly golden cross, the weekly uptrend hasn't changed much. But short term, at this level, even if it doesn't drop a lot, it could move sideways in a weak range. That means this bearish setup will take some time to play out, and once that's over, there's a chance it can head up again. And for Google, there haven't been any major fundamentals. Nothing big has changed, and technically, it's just working through its pullback among the big tech seven. It was the weakest on Friday, so short-term weakness is probable. But can we jump in and short it? Probably not. Yes, it looks weak, but downside is limited. There's not much room to profit, and the risk reward just isn't that attractive. There's not much edge. So shorting here isn't a great setup. Besides, if we look longer term, it's still in an uptrend. And after this pullback, the structure looks fairly stable. It's still above its trend line. That's a key support, and that matters. So even if it looks softer right now, the downside potential is probably limited. And chasing shorts here isn't ideal. More likely, price stays choppy and works through this weakness. And after that, another move higher is probable. So if it consolidates here, but even though we see this big bearish candle with strong downside, and it's already broken below the moving averages and also cracked the support. Those moving averages usually provide strong support, but at this point, let's wait and see. We need a clear signal that it's consolidating and working off this drop before moving higher. Even though it's found some support, the downside momentum is fading and is holding this level. That doesn't mean we will see an immediate reversal, and it's unlikely to hold up strongly in the very short term. More likely, at least for the next week, it will stay weak and choppy. Once it finishes consolidating, the odds of another move up are still high. So, in the short term, it needs some technical recovery. If we look at smaller time frames like 4 hour, for example, the 4 hour chart, you will see it's showing a top pattern with divergence. MACD is diverging. Price made a new high, but MACD didn't confirm the new high. That's a clear divergence. So a short-term pullback is normal. After a divergence, a small dip is typical. That's just a part of the process. What we need to watch for now is a clear sign it's stabilizing here. Then look for another push up. At the very least, let it form a base before buying the dip. That way, the odds of success are higher. At this point, especially after such a big drop, and with that kind of steep decline, plus the MACD bearish crossover, you can say the short term weak trend is clearly in control. Even if it doesn't drop further, it will likely chop lower. That's the most probable outcome. That's a high probability setup, so we wait for it to form a solid base and run here before looking to go long. That would be the ideal plan. Okay, that's our current take on the US market. That's our quick overview. If you have other thoughts or questions, feel free to leave a comment.